You know, sometimes reality is stranger than fiction. If you had told me a week ago that the global silver market, a market worth hundreds of billions of dollars, would be brought to its knees because the President of the United States wants to buy a frozen island in the North Atlantic, I would have told you to check your medication. But here we are. It is Sunday, January 18th, 2026, and the world has just changed. By now, you have probably seen the headlines. The mainstream media is having a field day. They're laughing. They are making jokes about President Trump trying to buy Greenland again. They are interviewing Danish politicians who are outraged. It is a circus. But while the media is laughing, the bullion banks in London and New York are screaming. Because buried in that tweet, hidden behind the headline about purchasing Greenland, is a single sentence that effectively destroys the logistical pipeline of the global silver market. President Trump has announced a 10% tariff on all imports from 8 European nations, including the United Kingdom, starting on February 1st. And if a deal for Greenland is not reached, that tariff jumps to 25% on June 1st. To the average person, this sounds like a trade dispute. It sounds like politics. But to the risk manager at JP Morgan or HSBC, this is a nuclear bomb. Let me explain why. The global silver market relies on a concept called fungibility. It relies on the idea that a 1,000 bar of silver in London is the exact same thing as a 1,000 bar of silver in New York. And more importantly, it relies on the ability to move that bar back and forth cheaply and easily. The banks play a game. We call it whack-a-hole. When the price of silver rises in New York because of high demand, the banks take silver out of their vaults in London, specifically from the LBMA, and they fly it to New York to flood the market and push the price down. Conversely, when London runs dry, which is happening right now due to the Indian and Chinese demand, they take silver out of the COMEX vaults in New York and fly it to London to refill the shelves. This constant flow of metal across the Atlantic Ocean is the lifeline of the suppression scheme. It allows the banks to pretend that there is always enough silver because they can just shuffle it to wherever the fire is burning hottest. But what happens when you put a 10% tariff wall in the middle of the Atlantic Ocean? The United Kingdom is on the tariff list. The LBMA is located in London, which is in the United Kingdom. This means that starting February 1st, if a US bank ships silver to London to bail out the LBMA and then tries to bring that silver back to the US, later they will have to pay a 10% tax on the value of the metal. At $90 an ounce, that is a $9 tax per ounce. That destroys the profit margin. It destroys the arbitrage. It makes the whack-a-hole game mathematically impossible to play. Essentially, President Trump just turned the United States border into a one-way valve for silver. Metal can come in, perhaps if it comes from a non-tariff nation like Mexico, but metal cannot leave for London, because if it leaves, it can never come back without a penalty that wipes out the bank's equity. This creates a trapped inventory scenario. The risk managers at the major banks are looking at this tweet right now on a Sunday, and they are issuing a stop-move order. They are telling their logistics teams to halt all exports. They cannot risk sending metal to London if they cannot get it back. This effectively cuts the LBMA off from the COMEX. It severs the connection between the world's two largest pricing hubs. And this is happening at the worst possible moment for London. We know based on the vault data we analyzed in our previous video that London is critically short of physical metal. The flows to India and China have drained the LBMA vaults to historic lows. They were counting on the 4.2 million ounces that were withdrawn from the COMEX on Friday to save them. They were waiting for the cavalry to arrive from New York. But because of this tariff news, the cavalry is not coming. The silver that was supposed to fly to London is now grounded in New York. This transforms the Friday night heist we discussed yesterday. We thought that metal was leaving the country, but now it is likely stuck here. This is bullish for the US price, but it is catastrophic for the London price. If London cannot get supply from the US, and they cannot get supply from the miners, where do they get the metal to settle their contracts? They don't. London goes into a physical default much faster than New York. The Greenland Tariff is a black swan. It is an event that nobody predicted, nobody priced in, and nobody has a model for. The algorithms that trade silver are programmed to look at interest rates, the dollar index, and industrial demand. They are not programmed to calculate the impact of a real estate dispute over an ice sheet in the Arctic. This is why human analysis matters. This is why you watch this channel. The machine sees a trade war. We see a liquidity trap. The banks are now forced to make a choice. They have to choose which market to save. They can keep their metal in New York and let London burn. Or they can send metal to London and trap it there forever, leaving New York exposed. They cannot say both. Because these banks are mostly US domiciled or have massive US operations, they will likely choose to protect the COMEX. They will circle the wagons around New York. This leaves the LBMA exposed to the full force of the Asian demand we discussed. The Shanghai vacuum is still sucking. And now the New York spigot has been turned off. We are about to see a bifurcation of the Western silver market. We might see silver trading at $90 in New York and $110 in London, simply because the metal cannot move between the two cities. The law of one price has been repealed by executive order. In the next part of this deep dive, we are going to look at the logistics of the trap. We are going to explain the concept of the Roach Motel effect in commodity markets. We will explain why this tariff forces banks to hoard metal domestically, even if they do and want to. It forces them to become preppers. And we are going to discuss why this accidental policy might actually be the most effective America First move for critical minerals. It inadvertently secures the domestic supply chain by making it too expensive to export our wealth. The media is laughing about Greenland, but the bankers are crying. And you, the silver stacker, should be paying very close attention because the walls of the prison just got higher and the silver is locked inside with you. We need to talk about a concept in commodity trading that is absolute life and death for the bullion banks. It is called the location swap. In a normal world, silver is liquid. It flows like water. If JP Morgan has too much silver in New York and not enough in London, they don't just physically ship it immediately. They often do a swap. They trade ownership of bars in New York for ownership of bars in London with another bank. The system relies on the assumption that eventually the metal can be moved to balance the books without a penalty. It relies on the idea that an ounce of silver is worth the same amount on both sides of the Atlantic. But President Trump's 10% tariff has just destroyed that assumption. He has turned the United States bullion market into a roach motel. You know the old slogan, roaches check in, but they don't check out. Well, now silver checks into the US, but it doesn't check out. Here's the logic that every risk manager on Wall Street is grappling with this Sunday morning. Let's say you are a bullion bank. You see that London is desperate for silver. You want to ship 1 million ounces from your COMEX vault in New York to your LBMA vault in London to stop a price spike. Sending it there is easy. There is no export tax. You put it on a plane, it lands at Heathrow, and you save the day in London. But what happens next month? What happens when the COMEX runs dry and you need to bring that silver back to New York to settle a futures contract? Now you have a problem. Because that silver is coming from the United Kingdom, it is hit with a 10% tariff at US Customs. If silver is trading at $90, you have to pay the US government $9 for every ounce you bring back. That $9 comes directly out of your profit margin. In the low-margin world of bullion banking, a 10% hit is not a loss. It is a catastrophe. It wipes out the profit of the trade 10 times over. So the risk manager looks at the spreadsheet and says, we cannot send the silver to London because once it leaves US soil, it effectively costs us 110% to get it back. the silver is trapped. This destroys the whack-a-mole game we discussed. The banks can no longer smooth out the volatility. If London spikes to $120 and New York stays at $90, the banks cannot step in to close the gap because the tariff wall is in the way. This creates market segmentation. It means we are going to see wildly different prices for the same asset, depending on where it is sitting. And this brings us to the accidental genius of the move. The media is focused on Greenland. They think this is about ego. They think it is about real estate. But look at the effect of the policy, not the headline. By trapping the silver in the United States, President Trump has created a domestic strategic reserve. We talked in our previous video about the need to secure critical minerals for national security. We talked about how the US Mint was running out of metal. Well, this tariff solves that problem instantly. If the banks cannot export silver to London because of the tax risk, that silver stays here. It stays in the COMEX vaults. It stays available for Tesla. So hold your position. Do not get shaken out by the volatility. Eventually, the price will settle much, much higher than $90. Thank you for being part of the boring currency community. We know there are copycats trying to steal our work, but you are here because you want the research. You want the dots connected. Leave a comment saying I'm staying with the original to let us know you are part of the real team. The week ahead will be one for the history books. Stay safe and keep your eyes on the physical reality, not the paper illusion. We will see you on the other side of the open. Subscribe